Welcome, dear traders. Last week on Wall Street was a rather lens. Traders assessed the results of the Fed meeting as well as the Nonfarm Payrolls report. There were almost no positive factors that could have boosted optimism. As a result, Wall Street closed in the red. A decline might have been steeper if not for strong non-farm payrolls data and a rebound in shares of U.S. banks. The new week started with a sluggish movement. Investors were hesitant to pick a trajectory. Stocks either rose or declined by several points. It appears that bearish sentiment may persist during the new week. And this week, investors are anticipating inflation data, the PPI, and the University of Michigan Consumer Price Index. Despite lots of events last week, investors did not get enough clues to make more accurate predictions about the economic prospects. Speculators are still concerned about the recession, and they are also uncertain whether the Fed will take a pause in its tightening in June. Find more interesting details in our video review. Please leave your comment down below and let's start. Fed Chairman Jerome Powell noted that the banking sector remains sound and stable despite the collapse of a First Republic Bank. He also said that the central bank needs to strengthen supervision and regulation to ensure the stability of the financial system. Powell pointed out that monetary tightening is already affecting the most interest rate sensitive sectors of the economy, especially the housing market and the business investment. Tighter lending standards amid the banking crisis may have a greater impact on these sectors. It could also influence economic expansion, employment, and inflation. And yet the outcome remains uncertain. In such circumstances, further decisions on a monetary policy will depend on the current situation. The Fed will take into account the cumulative tightening of a monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. It may help the regulator to decide whether it should make more rate hikes to achieve the 2% target. Before making rate decisions, the Fed will analyze current data and its impact on the economy and inflation. If it sees that more rate hikes are necessary, it will stick to a hawkish stance. The central bank is projected to make less aggressive hikes or take a pause in the tightening cycle, yet it's too early to assume that aggressive tightening is over. Inflation is still unacceptably high. It's neither growing nor falling. Traders did not get many clues from the Fed meeting. And this is why they are focused on a fresh macro starts to have a better idea of what to expect from the Fed. Besides, the decrease in stocks on Wednesday was mainly driven not by the Fed meeting, but by the possible bankruptcy of another regional bank. Market reaction was sharper at the end of Powell's speech at the press conference. Investors are tired of listening to obscure comments. On Wednesday, PacWest shares again faced a strong bearish pressure. The fact is that the decline in the yield of a two-year U.S. bonds by 15 basis points overnight was due to the banking crisis, not the Fed's comments. The banking crunch is in a full swing again. Since the start of the year, 4 banks have already collapsed in the United States: First Republic, Silvergate, Silicon Valley, and Signature Bank. PacWest shares plunged by 60% after the session closed on May 3. The sell-off began after Bloomberg reported that PacWest was winding on a range of strategic options, including a sale. Over the last year, the bank's capitalization has fallen by more than 80%. Following a drastic fall in the PacWest stock, shares of exchange-traded funds tracking U.S. regional banks plummeted to a three-year low. PacWest confirmed that recently it had been approached by several potential partners and investors, discussions ongoing. At the end of 2022, the Californian bank ranked 53rd among U.S. lenders with $41.2 billion in assets. The decision to seek a buyer to raise the new capital after the Federal Deposit Insurance Corporation seized First Republic Bank and sold its deposit and assets to JP Morgan. The size of the First Republic was the biggest bank failure since the 2008 crisis. On a Friday, tensions slightly eased. PacWest and Western Alliance shares rebounded sharply on a Friday by 81% and 49%, which led to a jump in the stock of regional banks. Sentiment improved after JP Morgan upgraded the rating of Western Alliance, Zinsbank and Comerica. The bank stated that the three banks were substantially mispriced, partly due to the short positions, and on Monday shares of regional banks climbed higher. Last Friday, Apple revealed an upbeat earnings report, so its shares jumped by 4.7%. The earnings season is coming to an end. This week, Disney and PayPal quarterly results are on tap. Last Thursday, the Dow Jones as well as other main stock indexes shed large losses due to the risks of a recession and banking crisis. The Dow dropped by 2.8%, the S&P 500 dived by 2.6%, and the NASDAQ fell by 2.1%, lagging the worst weekly performance since early March. Last Friday, they recovered slightly, and the Dow climbed by 540 points on Friday. Its increase was facilitated not only by a sharp rebound in regional banks' shares, but also by a strong Nonfarm Payroll report, which eased recession fears. The weekly price fluctuations of the Dow Jones amounted to 1.5%, and that's the index of the biggest losses. Markets are again gripped by uncertainty. Speculators are worried about the looming recession, yet the labor market remains tight. There are reasons for optimism and pessimism as well. In general, economists believe that the U.S. economy is gradually slowing down because of high interest rates and a fall in the lending amid bank runs. However, after the release of non-farm payrolls data, some analysts are not so sure. They expected average hourly wages to total 180,000 in April. However, the actual figure stood at 253,000. The unemployment rate also confused investors. The indicator unexpectedly fell to 3.4% from a 3.5%, while an increase was projected. High labor demand and the low unemployment have dispelled not only recession fears but also lowered hopes for a pause in a tightening. If unemployment had risen, the Fed could have stopped its aggressive tightening. Besides, last Wednesday, the Fed hinted that it might not hike the key rate in June. However, things may change in the coming weeks depending on incoming data. This week, investors will focus on the inflation reports. They hope to get more information about price pressure and the monetary policy prospects. Meanwhile, one-year inflation expectations fell to 4.4% in April from a 4.7% in March. At the same time, 3- and 5-year expectations rose to 2.9% and 2.6% respectively. The S&P 500 managed to recoup most of its losses. On a Friday, the S&P 500 advanced by 1.8%. Its weekly losses amounted to 0.9%. Friday's rise could have been driven by strong selling in the market as well as a high volatility amid the expiration of options. This trend is unlikely to continue in the new week. Investors will not have to worry about what policymakers might say. The further steps on a monetary policy will depend on macroeconomic data. If inflation remains high and the economic data is positive, a new increase in interest rates is possible. Nevertheless, a dovish scenario looks more likely. The annual inflation is projected at 5%, and the core one is likely to average 5.5%. However, traders will be more interested in the monthly indicator, which may total 0.4%, and the core indicator is expected to be 0.3% on a monthly basis. Both indicators are still too high. Before the June meeting, another employment report and CPI will be published, so everyone has time to digest the figures. The S&P 500 index has been moving in the range of 4,100 and 4,200 since the end of March. Apparently, bulls are unable to push the index above 4,200. They will hardly succeed given that the earnings season is almost over. The top companies that have been boosting the rally of the index for some time have lost steam. The index could go down, and the S&P is expected to fall by 200 points in the coming weeks. The NASDAQ rose by 2.2% on Friday and gained 0.1% over the week. Despite the decline, the index managed to reach its 37-week high. The NASDAQ is sliding into a narrow range. Consolidation seems inevitable, which means that the upside potential will be limited to the current levels. In the near term, a decrease is also possible. However, it's better to wait for a clear breakout and only then talk about a downtrend. The price is unable to settle at 12,500. If there are strong drivers, the index may reach 13,600. So far, this is the highest level the index could hit. However, there are still lots of bearish factors. White House officials noted last week that an actual breach of the debt ceiling would likely cause severe damage to the U.S. economy. In the event of a protracted default, the country's GDP could tumble by 6.1% and 8.3 million people will lose their jobs. According to the forecast, a short default would see 500,000 jobs lost and unemployment rise by 0.3%, while knocking a 0.6% off annual GDP. A protracted default lasting a full fiscal quarter would lead to a 45% fall in stocks. GDP would shrink by 6.1% and unemployment could rise by 5%. And that's all for now. Don't miss our next video review and see you online.